Hi, and welcome to Financial Planning Explained, and I'm your host, Mike Menninger, Certified Financial Planner, owner and founder of Menninger and Associates Financial Planning. We tend to, on this show, my goal is to provide an educational experience and where possible, entertaining on the different areas of financial planning. 6 areas of financial planning are cash management, tax planning, which I thoroughly enjoy, risk management, investment planning, which I enjoy, retirement planning, and estate planning. Today we're going to talk about investment planning, and I've got my third guest ever on the topic of investment planning, or shall I say the third investment specialist. Just so happens that the second one was Mike Guman, and all we talked about was his career as a running back at Penn State and in the NFL. So we didn't talk anything about investments, but that was okay because I had a whole lot of fun that day, and I hope everybody enjoyed that particular episode. So anyway, we're going to be talking about investment planning, and today it's kind of an interesting topic on alternative investments. And you know, alternative investments are what? Those things that are an alternative to investments. All right, good. You're an awfully smart guy, Mike. But anyway, I'm here, and I would like to welcome my guest today, Gaston I blow it every time.
Escudero.
Escudero.
All good. Happens all the time.
Gaston, thank you very much. I appreciate it. So,
yeah.
Thanks for coming on. So, tell me, what are alternative investments?
Yeah. So, alternative investments are defined as an asset class that's non-traditional. Right, traditional asset classes are stocks and bonds, and
right.
CDs, more cash account type investments. Alternatives can be real estate, it can be infrastructure, it can be private equity, it could be non-bank lending, it could be hedge funds, oil and gas. I mean, really everything under the sun that's not traditional is considered alternative technically. And the goal of an alternative investment is to give you a return that's non-correlated or has zero correlation to stocks and bonds.
Right.
So that's what that definition is, simply put.
Right, and so what I tell clients when I try to give them investing 101, I tell them about there's 3 different asset classes, and you got stocks, you got bonds, and you got cash.
Yeah.
You know, CDs, money market, and everything else like that. Now, there's way more asset classes. You got commodities, and you got real estate, and all that. But I try to show that, and the problem is that, you know, generally speaking, stocks and bonds react the opposite of each other.
That's right.
And when we're talking about it, alternative investments in real estate is a perfect example of an alternative investment, because if the stock market's going up, it doesn't have an impact on real estate. If stock market's going down, it doesn't have an impact on real estate. Yeah. And same goes with the bonds. And ideally, you know, we preach diversification and asset allocation. That's fundamentally, we preach that because that enables you to throw a bunch of different types of investments into a portfolio, and the more diverse they are, actually it reduces the overall risk to the portfolio, and that's the whole idea of adding alternative investments.
That's right.
For a while there, I was introduced to the alternative investments. I'm beginning to embrace them more now, as you know, because you know we're in a very low interest rate environment. And in a rising interest rate environment, the risk that we run is bonds lose value. Now, I'm going to get today's disclosure. I forgot to bring it at the beginning. So in our industry, in both of our industries of investing, we both have a strong hand that beats us over the head called compliance. So if during the course of this episode, either one of us says something that we're not supposed to say, and compliance tells us you're not supposed to say that, we may find after this show is over that we have to actually edit out. So if all of a sudden it goes and it's like, you know, it reminds me of the bleeping you hear. Well, they're going to bleep it. They're going to make us cut it all out. So we're going to do everything we can today, all right, without saying anything that we're not supposed to say. Good luck with it.
Absolutely.
All right? So anyway, so again, the whole idea is to develop a portfolio and to that's diversified and with a bunch of things that react different. And the risk that we run today, and I call it a risk, is if you took the average portfolio that they talk about, they say 60% stocks, 40% bonds. For me, who as an advisor, I'm guiding my clients, okay, you got 60% stocks, inherently they have more risk. It's hard to knowingly put 40% of a portfolio into bonds that traditionally lose value in a rising interest rate environment.
That's right.
Okay, guess what? Breaking news. We're in a rising interest rate environment.
Yeah, we're on the precipice right now.
Exactly. And so actually, we are potentially exiting a 40-year period of a decreasing interest rate environment.
Yeah.
Where all those years bonds did well.
Yeah.
But now if we're near bottom
Yeah.
of interest rates,
Yeah.
I mean the bottom was really
Sure.
in the midst of COVID.
Yeah.
Okay, because why? Everybody buys bonds and the interest rates go down. But now what do you do coming off the bottom? And that is one of the areas where alternative investments helps. Is that?
Yeah, I mean, alternative investments, I mean, investors have been investing in real estate, private equity, various types of alternatives for 50 years. Mm-hmm. And really up until 10, 12, 13 years ago, retail investors started investing in alternatives because, like to your point earlier, 60-40 portfolios did the job for a very long time. Mm-hmm. And I think when you saw the downturn of 2006, 2007, you saw 60-40 portfolios get crushed, you saw retail investors looking to make adjustments for any type of a downturn that might happen down the road. And so you're seeing institutional investment firms bringing high quality alternatives to the retail channel to help fund retirement, right? Today, you have investors that are aging into retirement every single day, all day long, and they're living longer. Mm-hmm. And we're in this low yield environment. How can you fund retirement appropriately right now and really fund objectives and goals? And so alternatives can really be a great bond complement, right, or a bond replacement, one or the other. It's important to have certain fixed income with that principal protection, but today, given where the low yields are, even with high quality bonds, 10-year treasuries, it's really tough to find income today. So alternatives can really be a great complement right now.
Well, it's interesting, and I've seen, we look at this stuff all the time,
yep.
is we're actually inverted, and that's probably not the right word, but we're at a point where real returns are negative.
Yeah.
Okay, and what I mean by real returns is if you were to buy a 10-year treasury, okay, which is the U.S. 10-year bond, yep. which is what is fundamentally revered as the sort of the standard. Yep. People, it's used kind of as a fundamental for mortgage rates. Yep. And they compare the 10-year treasury to the Europe's 10-year treasury and Japan's 10-year treasury and China's 10-year, whatever they call the treasuries over there. Yep. But what's going on today, and it's been going on for a little bit, is that inflation is higher than the yield you're receiving on government bonds.
That's right.
So if I were to go buy government bonds and earn, let's say, a 1.5%, and inflation is 4%, I'm running negative.
Yeah.
Okay,
yeah.
So I got to figure out a way,
yep.
as an alternative to bonds.
That's right.
Not to mention if interest rates rise,
yeah.
the value of a particular bond actually goes down. So that is really tricky on our side.
Yeah, I mean, right now with the amount of money in the U.S. Government system, and I mean, obviously last year was unprecedented with COVID-19 and the need for stimulus, which was obviously warranted. But asset prices are increasing right now. Consumer prices are increasing. Inflation's starting to pick up now. So you almost have to increase interest rates so things don't overheat.
Right.
So you really got to get ahead of this thing and make certain adjustments where it's tough to make because equity markets are up, people are making money. So it's tough to justify being defensive and taking some risk off the table. But I think it's really important to hedge portions of your portfolio against interest rates rising where fixed income will not serve as a hedge. But real estate, for example, real estate is probably one of the best hedges against interest rates rising because you can raise rents right. faster than the rate of inflation and interest rates because the economy is so strong that it warrants increasing interest rates.
So let's talk about real estate.
Yep.
So you brought that up.
Yeah.
But you talked about rents. So I know, I mean, we're in, well, okay, there's two ways of looking at it. Number one, you got commercial real estate, and number two, you got residential real estate. So residential real estate, I mean, it's been crazy
Yeah.
for the last year and a half.
Sure.
You put your house on the market, you know, you get 40 people go through. One day later, you've got 15 offers above what your sale price was.
Yeah.
Okay. Is that wise to be buying into real estate when the real estate market is, I'll call it irrational exuberance, if you remember those terms?
That's a great term right there. And you know what? That is a big concern that I hear a lot from folks like yourself and their clients. And yes, it's unprecedented what home prices have been doing. And what a lot of people, I think, may forget is that what led to the last housing crash of 2006, 2007 was because of overlending and overbuilding. That combination really is what was the bubble burst.
Right.
Today, we're in a housing shortage of about 7 million homes that are not being built to meet the growing demand for new housing. Not to mention, you know, the biggest generation throughout the country is millennials, 75.5 million millennials, and they are all aging into creating households.
Well, yeah, they're the baby boomers' kids.
That's right, and they don't have savings.
Right, well, that's
You
a
know,
fact.
and especially in blue collar America, where maybe the average income is lower, you know, not only is buying a home today tough to do, but they don't even have the wherewithal or the balance sheet to be a homeowner. And so right now we think that this housing shortage we're in is going to persist for 10, 15, 20 years.
Really?
It's not going to happen
So in
overnight.
other words, what you're saying is you don't think that the value of homes are going to stop going up, or at least maybe not as crazy, but they're not going to come back down,
It's not
at
gonna,
least for a while.
It's not going to be some sort of an abrupt crash, landing, if you will, because you've got that protection from this shortage, right? There's no overbuilding being done. A concern would be overbuilding where it's tough to get someone to move into.
Supply and demand.
Exactly.
But you were referencing earlier raising rents and everything else like that.
Yeah.
That's different than actually buying the real estate, isn't
Yep.
it? You're talking about what they call mortgage REITs,
Yep.
real estate investments trusts. It's REITs.
Yep.
That's what their acronym. But are you referencing literally buying the properties, or are you talking about owning the properties and then your revenue is associated with bringing in the rentals?
Yeah, so commercial real estate can be everything from office, it can be industrial warehousing, it could be retail shopping centers, it could be hotels, healthcare facilities, single family rental homes, it could be apartment complexes, really any real assets that are income producing is extremely important right now. But more particularly on the rental side, to your original comment, given the affordability issues right now throughout the country, you're seeing this demand for renting apartments. You're seeing demand for renting homes, given the cost of being a homeowner today.
Sure.
And so when you see that, and you also add in the extra outlier of COVID-19 and what that did from people migrating away from smaller spaces towards the suburbs.
Absolutely.
You have certain apartment units or even single family rental units that might have 10 to 15 people trying to move into one unit. And so from a landlord perspective, you can increase rents.
Oh yeah, supply and demand.
Supply and demand right now is very favorable for real estate. And so we may see a little bit of some equilibrium, especially if mortgage rates rise. That's going to make the cost of buying more expensive. But we think this housing shortage is here to stay. Okay. Given the cost of building a new home and the lack of land to build on, and this labor market we're in is very tight. So hiring new workers to build new homes is tough. So home builders are having a tough time, having profit margin on new homes being built. So
I've seen that. I've heard that.
All the homes being built today are typically $300,000, $400,000, $500,000 or greater, because that's where you make that profit margin. But on the low end, is almost non-existent relatively to where it has been the last 20, 30 years.
Okay, brought up some good points. I'll tell you what, we're bumping up on break. I'd like to pick up this when we come back.
Sure.
You'll be with us, we'll be back with you in just a few moments.
Have you saved enough for retirement? Are you financially prepared for an emergency or unexpected event? Have you thought about your financial future?
Hi, I'm Mike Menninger, founder of Menninger and Associates Financial Planning. For over 20 years, we have been answering our clients' questions just like these as we develop unique and comprehensive financial plans tailored to meet their needs. When addressing your financial plan, we incorporate your entire financial picture, including taxes, estate planning, as well as investment planning and retirement planning. So call us today for a complimentary, no obligation consultation.
A unique approach to financial planning.
Welcome back to Financial Planning Explained. I'm Mike Menninger, your host, certified financial planner, and I'm here with Gaston, who is our guest, talking about alternative investments. And cut you off almost mid-sentence on the for the break, but you were talking about real estate, and again, I want to really differentiate. You brought up a concern that I had of residential real estate being in a bubble, but kind of the way you were explaining it, it's a strong supply that a demand can't keep up with. So it's going to take a long time for that market to even think about going down. There's no economic drivers to do that. So what you're talking about is a company like BlackRock. They were in the news 3-6 months ago. Didn't they buy like tens or hundreds of thousands of houses, not dollars of houses, houses, didn't they?
Yeah, I mean, the largest money manager, you could argue it's BlackRock or someone like a PIMCO, and BlackRock has just entered into the residential rental housing market. I think maybe spent about $6 to $7 billion.
Yeah, so that's amazing. So what you're saying they did, in theory, they buy $6 billion worth of homes.
Yeah.
Okay, if the real estate market operates independent of the stock market and independent of the bond market,
that's right.
Basically what's happening is the underlying value of those $6 billion, $6 billion worth of assets, if they're spitting out rental income, that might be 5% of the portfolio, then guess what? You're sitting back and just collecting 5%.
And not to mention the tax benefits you get from being in real estate too, that traditional asset classes don't provide.
Right. Okay. But is that passed on to the investor, like a small investor, or are you talking about to the big BlackRocks of this world?
Well, even if you went out and bought an investment property yourself, you would have the same tax benefits at a smaller scale versus maybe someone coming in with $7 billion.
Okay. I get it.
Which is depreciation, which you can pass on. So there's certain structures out there that will pass on all those benefits to investors.
Okay.
Yeah.
You referenced commercial real estate, and this is, I don't know that I want to argue against it, but this is a concern I have.
Yeah.
Okay. Ever since we had COVID, we had the realization that, people can work from home, and all of a sudden they realize, hey, you know what? We're still getting the job done, and our profits are still good. And I remember when I was running, before I got into being a financial advisor, I was basically running all of the profit and loss in the books, of a consulting firm.
Yep.
And that's where your assets go out the door at 5 o'clock every day.
Yep.
The reality of it is that after payroll, your single largest cost to the bottom line is rent. And if a company is renting 100,000 square feet and they realize, holy smokes, I can get away with only 50,000 because I can get all these people working from home.
That's right.
That's going to increase the bottom line of the company.
That's right.
Guess what? If everybody's realizing this, then I would imagine that not overnight, because if I'm in a 5-year lease, or I'm 5 years into my 10-year lease, I still got 5 more years. I can't reduce my 100,000. But this, I have to imagine, is going to put a tremendous amount of stress on the commercial real estate market, which could flip that one upside down, unlike the real estate market, I mean, the residential real estate. Do you agree?
Yeah, I think there's many different sub-food groups of commercial real estate. Commercial real estate can be traditional office, which I think is what you're alluding to. That's probably one of the tougher places to be right now, is traditional office, to what you mentioned. So. But like a grocery anchored Whole Foods or some big grocery store with a Starbucks and banks and nail salons,
as
yoga
long as
studios.
They didn't all get shut down during COVID.
Yoga studios. Those are many reasons why people leave to go and pay for goods and services, or those types of. So there's some good retail opportunities out there. But office is a tough place to be.
I could
see
that.
Hotels took a hit last year.
You could have the the warehouse facility for Amazon, which that's bad.
That's a really good point.
Walmart, Firestone. You can have all these warehouse facilities.
Yeah.
Even manufacturing facilities, if they're still doing it.
Absolutely.
Okay, I could see that, but office space would probably be under.
Industrial warehousing, last mile, distribution centers, healthcare, certain healthcare facilities, aren't going anywhere. Self-storage is a good place right now. But yeah, I think office is probably one of the riskier places right now in the commercial real estate space, which working from home, that's the direct hit.
Absolutely.
Absolutely.
So you referenced earlier in the show private equity, and I think of private equity because I have a variety of different business clients who their company was bought out by private equity, which, they may have paid $30 million to buy the company. Okay, well, I don't have $30 million.
No.
But how do you get into that?
Sure.
And by the way, what's the difference between private equity and basically if I bought a company, it's no different than me buying 100% of the company's stock.
Sure.
But what do you mean by private equity, and how does the average individual get in, or can't they really?
Yeah, it's a great question. What's really interesting, and I learned this a few years ago, is about 98 to 99% of U.S. companies today are privately held. You see a very small sample.
90% of the companies, not by volume, but by the number. Okay. I'm a private company.
So the majority of all U.S. companies, whether they have $10 of revenue or they're an Amazon or some big private company.
Right. Yeah. Amazon's not private.
Amazon. They're privately held, and no one really knows they exist. They're not publicly traded. You can't buy shares into them, and so there's a whole world of private U.S. companies that need help growing. And after the last downturn of 2006, 2007, where banks were lending on riskier assets, there's been some restrictions since then.
Right.
And so a lot of the big banks can't lend on companies that have 50 million or less in revenue.
Right.
So you've got companies out there that are considered non-bank lenders or private equity partners that will inject or lend on private businesses.
Business development corporations?
Yeah. So whether you're on the debt side of the company, or you're an equity partner, you can help a company grow and they hit a certain multiple and there's maybe a cash out opportunity. So there's a huge universe of private equity where you can make a lot of money. And the part that is really neat that's considered an alternative is that that's not publicly traded.
Right.
So as the stock market's doing this, that private company is obviously not being valued every single day, all day long.
Well, you know what? It's funny you say that because I encountered one that was just that. It was a business development corporation. And what they do is they're middle market lenders.
Yeah.
Okay, so they're lending to the
smaller
too big
businesses.
for a bank, too small for Wall Street.
Yeah.
And you'll lend them $100, $200 million. And basically they're lending them at higher rates.
Yeah.
And you can buy into that. So, okay, I could see that. I've also encountered, I don't know how to broach this, but I'm going to broach it anyway, investment firms that offer a couple different types of investments. I've heard of long-short funds and mergers and acquisition funds. I know you're not as familiar with long-short, so explain what that is. What a long-short fund is and there are investments out there. Okay, they're mutual funds, but they're actively managed mutual funds where they look within a particular industry group and they'll buy one and sell another that's just like it. And what that basically does is enables them to, if that particular industry group grows up, well, guess what? They got the one that they bought, and then that gains value, and the one that they sold short loses value. But that's where the stock, I'm not picking two companies that are the same, but let's say IBM and Dell are similar. Then one goes up, they buy the one that they think is better, sell the other one. Or I've even seen them, they buy a bunch of different stocks and then sell short the indexes. I tell you what, that's nothing that I want to get into, but there are companies that do that or buy and sell options within the fund. But then there's another one out there that I know extremely well, and you also know extremely well, is a mergers and acquisitions fund. Okay, where it plays on the arbitrage. Okay, and what's the arbitrage? I'll give you an example. Well, you tell me about it. I know what it is. You tell me about it. It's your expertise.
The last 25, 30 years, you've seen just how globalized the world's become.
Right.
And the advancement of technology. And you've got, I hate to use Amazon as an example, but they're a great company to look at, because the quickest way for any company to grow or to add a new business line is through a merger or through an acquisition.
Yeah, buy somebody else.
Yeah, and a lot of it is not hostile takeover. It's more friendly, partnerships. And so there's opportunities, for investors, myself, or even my company or anyone, to take advantage of the hundreds of millions of dollars of mergers and acquisitions that are occurring monthly right now, especially in technology, logistics, cloud computing, really just the essential e-commerce horsepower behind the future longevity of every company in the world today. And so you can invest in certain companies that are about to be purchased, and capture a certain spread there.
Which is the arbitrage.
Right.
And
arbitrage can sound like a very fancy word, or
actually sounds like a scary word.
It's a scary word, but it's very simple. And,
it is simple.
And that's an alternative investment in a nutshell, is doing something to achieve a return that's not a traditional buy a stock and just hold on to it and hope that it goes up.
And so I'll give an example that I don't think are going to get yelled at or cut it or edited for. Is it's not a great example, but it is a good example. Is if for some reason Pfizer wanted to buy out Merck.
Yeah.
Okay. They may have things that the two of them together would be bigger and better.
Yeah.
Okay. And this happened for not decades, but certainly in the 90s. What would happen is the number 3 aerospace contractor would merge with the number 4 aerospace contractor to become the number 2, so that they can get the government contract.
Yeah.
Okay, they were doing it all the time.
That's a great example.
But the example might be, and let's just say, for instance, that Merck stock is $80 a share. Let's just pick at that. But Pfizer says, I'll buy you at 90.
Yeah.
Boom. Merck does not jump all the way to 90.
No.
It jumped like 88. And so what a mergers and acquisitions fund does is it'll buy the Merck stock at 88, knowing full well it's going to go to 90.
It's a high probability.
Right, high probability.
And that's where there's hedging in place in case it doesn't.
Right.
But yeah, that's a great example.
Yeah.
Absolutely.
So how does an investment like that exactly generate the income every month? Is it through selling puts and call options, or is it just there are so many deals that go on that each month it's producing that gain?
So I've got my compliance ringer going off right now, so I can't really get into too much detail. But it's, a lot of these deals, there's so many companies that do these types of opportunities.
Right.
And the average duration for a deal might be 5 or 6 months. So every 5 or 6 months, you've got realized gains that are being produced from some of the underlying spreads that we're capturing. And there could be dozens and dozens of deals at a time.
Right. So if you have a bunch of them.
Yeah, throughout the year.
Right. It's just numbers. It's just a numbers game. I mean, if I had 100 of them that I had in my portfolio, so to speak, then just if I had 120 of them, 10 of them should happen every month, theoretically.
And this isn't, this is mergers and acquisitions are happening all day long, all year long. But do I want to read 5,000 pages worth of SEC filings to decipher if I can get 10 basis points?
Right. No, I understand that.
So that's where you've got experts, funds that are available with you, and that's to answer your question from before. How does a retail investor get access to this type of stuff? They really can't, and that's why there's certain mutual funds and there's certain structures. If it hits, there's certain, threshold of requirements and compliance, they can very well get access to through you.
Right.
So that's.
Thank you very much for your explanation on a lot of alternative investments. Believe it or not, we're done.
Yeah.
I'm done with you for today.
All good. Time to go home.
Exactly. Well, anyway, so this is a great type of discussion as it pertains to the investment side. Okay. It's also important to understand as it pertains to each of these different types of investments, whether it's REITs, whether it's private equity, or mergers and acquisition type funds, arbitrage. Understand anytime you're dealing with something, you really need to know and understand the risk associated with it. is it producing dividends? If it's producing dividends, are they taxable from a qualified dividend, a non-qualified dividend? And then when you do something like that, then you need to decide, do I put it into my tax-free account? Do I put it into like a Roth IRA? Do I put it in my tax-deferred account like an IRA? Do I put it into a non-qualified account where I'm paying taxes on it? So the long and short of it is that this is a good time as an alternative to bonds, where this is a tough investing environment for bonds as an overall portfolio. Yeah. So I hope everyone's learned something today. Thank you very much for joining us. I hope you have a wonderful week, and we'll see you next week on next episode of Financial Planning Explained. And I'm your host, Mike Menninger, Certified Financial Planner. Have a great week.